And welcome to Taking Stock for the week ending 16th of September. My name is Jason Yin, and joining me today, it's my pleasure to welcome Lincoln's Senior Portfolio Manager of the Lincoln Managed Funds, Matthew Swartz. Matty, great to have you on.
Hello, Jason. Thanks for having me. And can I say, I think you're doing a great job hosting in Kian's absence.
Oh, I'm blushing, Matthew. I'm blushing. Look, a quick note before we start. Thursday and Friday next week are public holidays as Australia mourns the Queen's passing and the grand final here in Melbourne. So as such, we will not be filming a Taking Stock episode next Friday. Also, the information provided here today is of a general nature and should not be considered personal advice. Shares are volatile, so any charts and tables presented should not be relied upon as a guide for future performance. Well, Matthew, each week that goes by, I always get a sense of deja vu now. It's the same reoccurring factors that are driving market sentiment up and down, and that's the market's obsession with inflation. The CPI index released every month in the US is becoming a market spectacle. And on Wednesday this week, the US headline year-on-year inflation print of 8.3% came in slightly higher than the expected 8.1%. But the measure the US Fed tends to use as their gauge for inflation, which is the year-on-year core price index, this strips out the volatile energy and food components, increased on the previous month to 6.3%, leading to a brutal sell-off on Wall Street.
You are correct, Jace. Brutal it was. Traders and speculators this time delivered what I'm describing as an almighty dummy spit, sending the S&P 500 over 4% down for that particular session, marking one of the worst trading days since the onset of the pandemic. And as we all know, when the US sneezes, the rest of the world catches a cold. And Aussie markets were no different to global markets, cratering that day more than 2% on that Wednesday.
But were the inflation numbers really that bad, Matt?
Well, look, the reality is that on a month-on-month basis, Jace, the headline inflation was only up 0.1%. And the month before that, prices were flat. So if we're taking the half glass full approach, the last couple of readings have shown that headline inflation has eased somewhat. But beneath the surface, the fairly low monthly reading was entirely assisted by deflation in energy, as crude oil and gas prices have fallen significantly since their peak a couple of months ago. So what is clearly concerning the market is the continuing price pressures across the services basket. And this includes stuff like shelter, medical services, and transportation. And you can see on the graph here that that core services prices here in yellow have continued to push higher every month this year. And the Federal Reserve will clearly be concerned at this trend when they meet at the end of the month to make a decision on monetary policy. Now, markets are expecting yet another 50 to 75 basis point rise in the federal funds rate at this particular meeting. And if we look beyond September, investors are now expecting further aggressive rate rises into 2023, where rates are expected to top out at about 4.7% and then pause. Look, at the end of the day, investors need to make peace with the fact that the good old days of cheap money are a thing of the past. We've said it before and we'll say it again, make sure you're doing your financial health audits on every stock in your portfolio and stick to companies with strong balance sheets and defendable profit margins. Whilst I'm personally optimistic that inflation pressures will continue to moderate over the next few months, investors need to be prepared for more volatility whilst the economic picture becomes clearer. This is not to say that stocks are going to go down. They could easily push higher, but don't try and time the market. Stay diversified and think long term.
Hey, thank you so much for that fantastic wrap-up of the inflation thematic this week, Matthew. It was a pretty quiet week in terms of announcements from our style growth stock universe, so I thought it was worthwhile to cover some of the notable news events. Now, Ramsay Healthcare, private equity shop KKR has pulled the pin on its proposed $20 billion takeover of the healthcare company. And this follows a string of failed private equity bids this year. Ramsay Healthcare was a previous borderline star growth stock, but we ceased coverage of it in late 2021 due to a decline in earnings and return on equity. What's going on with all these failed bids, Matt? Seems like private equity is only too happy to offer an initial price and then later on pare back their bid after some due diligence.
Has been somewhat of a trend, hasn't it, Jason? Look, attractive investment opportunities are limited in the current environment, so private equity is desperate to deploy their capital and sometimes offering bids before all the cards are revealed. In the case of Ramsay, we're hearing two versions of events. The Ramsay board believed they worked diligently in the interest of shareholders to get the maximum price while being dragged through a process that ran about 6 months longer than it thought was necessary. And KKR, on the other hand, believes that it dealt in a timely and courteous manner to get a deal done while being frustrated by the lack of cooperation of Ramsay's French subsidiary.
So it sounds like a classic case of he said, she said. The other common factor that I've noticed with these failed takeovers is that private equity tends to come back to the table with a lower share price than their initial offer. Of course, most management teams would certainly object to these lower offers.
Yeah, and after much deliberation, KKR did revise their cash offer of $88 per share to 78.20 cash for all the assets except the French subsidiary. And obviously, the Ramsay board did not want to entertain the lower offer, hence the deal was pulled. Takeover opportunities are obviously very hard to spot, but what we've learned over the past couple of years is that if a company is on the receiving end of a juicy offer, you should probably take substantial profits into the strength rather than sit around waiting for a higher bid or the deal to close.
Sage words of advice there, Matthew. Thanks for that. Another failed takeover this week relates to Link Holdings, who provide outsourced administration services for superannuation funds and corporate markets. Members should note that Lincoln would not invest in a stock like Link because it fails a fundamental golden rule 1, which is financial health. This poor rating was caused by inadequate cash flows and a high percentage of liabilities to total tangible assets.
And this week, Link's stock entered a trading hold amid speculation about a last-minute hitch in gaining approval from UK financial regulator, which has the potential to put the entire $2.5 billion buyout by Canada's Dye & Durham in jeopardy. So in a nutshell, the regulator is insisting that Link's acquirer must cover any shortfall not already set aside on the balance sheet for potential restitution that may be levied on the UK subsidiary in relation to the failed Woolford investment fund, of which Link were the trustee at the time. Now, Link's indirect involvement in the potential fraudulent fund continues to be a recurring nightmare for its shareholders. And now most analysts are expecting that the deal is unlikely to go ahead.
And certainly more headaches for its shareholders, Matthew. Thanks for that wrap up. Taking a look ahead in the corporate calendar, Star Income Stock and Star Growth Stock Premier Investments will report their annual results on the 23rd of September. And in under the microscope this week, we shift our attention to ex-Star Growth Stock MA Financial. We ceased coverage of the company in late August following a deterioration of its financial health rating. MAS, formerly known as Moelis Australia, is an Aussie asset fund manager and financial services firm. The company is also one of Australia's largest specialty fund managers for high net worth Chinese clients. And this characteristic was the crux of this week's sell down.
Yeah, that it was, Jason. And on Monday, the company's stock dived some 20% on speculation that the Australian government may be scrapping its significant investor program, otherwise known as SIV, in the upcoming budget review. In FY21, about 40% of the company's total assets under management were from foreign high net worth clients. So given the dependency on foreign investors, any adverse changes to this program could negatively impact the firm's future equity inflows and growth prospects.
Yeah, I actually remembered the market's reaction on Monday, Matthew. There was no announcement. The news flow was pretty thin. And I think at that point in time, nobody really knew where the selling pressure was coming from. I think you actually reached out to some of our market contacts to understand what was happening. And it was only then that we understood there could be potential changes to the SRV program. But by that time, the stock was placed in a trading hold.
Yeah, and in management's address to the market, which was potentially a little bit late, they tried to put out some of the fires by stating that about 85% of the group's equity flows since the start of FY22 had been derived from non-significant investor visa investors. Furthermore, management have reaffirmed their FY23 earnings guidance, which provided some level of relief to investors, though earnings revisions have been quite negative.
So aside from the potential changes to the SIV program, which potentially could be felt from FY24 onwards, there were other active risks to be aware of, especially against a backdrop of rising interest rates.
Yeah, good point there, Jace. Property makes up about 60% of the total assets under management, and higher interest rates could potentially put pressure on valuations. And furthermore, its lending business, which represents about 20% of its first half 22 earnings, could also face higher rates of default if borrowers cannot satisfy their mortgage obligations. But operating risks aside, a weakening MAF's financial health rating was enough for us to take pause and exit our position. Obviously, with financial health deteriorating, the Lincoln Australian Growth Fund has also removed its exposure from the stock.
And now for question of the week. So with the upcoming $90 million off-market buyback program by Star Growth and Star Income stock McMillan Shakespeare, several clients have actually asked us about the merits of participating in this buyback. I must reiterate that our opinions and commentary are of a general nature and do not consider your personal circumstance. So first off, Matthew, what is a share buyback and what is the difference between an on-market and an off-market buyback?
Well, let's deal with the first part of that question, Jace. The stock buyback is simply a corporate action whereby a company uses either its existing cash or debt on its balance sheet to buy its own shares. Now, reasons for a buyback include potentially reducing the cost of its capital, consolidation of its equity ownership, providing a positive signal for its share price, and potentially boosting certain financial metrics, including earnings per share, return on equity. So the differences now relate to on-market and off-market. Non-market buyback is conducted in the open market. So the company is effectively bidding for stock on the stock exchanges during normal trading hours. And an off-market buyback is somewhat different. So typically a company will offer to purchase shares from its existing shareholders at a discount to the prevailing share price at the time of the off-market buyback transaction. And the reason why an investor may want to accept a lower price on their stock is because they will be compensated with fully franked dividends. And for shareholders that get real utility out of franking credits, such as pension phase self-managed super funds, the dividends and the franking credits you'll receive as compensation for selling your stock back to the company in the buyback will typically outweigh the value of your shareholding that you have put up for tender.
Wow, fantastic. So MacMillan will be conducting an off-market share buyback program, and the company is seeking to buy up to 10% of its shares or up to $86 million. Eligible shareholders are invited to tender a price they'll be happy to receive for their shares, which will range from a discount of 10 to 14% to the market price. Now, the market price will be calculated based on the volume average weighted price over the 5 trading days up to the closing date, which is the 21st of October, 2022. So, how should investors approach the buyback to MMS? Step 1, decide how many shares you wish to sell back. If you hold 166 shares or less and want to participate, then you must tender all your shares in one parcel. If you hold more than 166 shares, you can tender different parcels at different tender discounts or a different final price. However, you must tender a minimum of 166 shares in total. Step 2, you can select the tender discount of between 10 to 14% discount, and this is inclusive of the 14% at 1% intervals. So if the buyback price is less than your tender price, the company will not buy back your shares, and under no circumstance will your shares be bought back at a lower price than your tender price. In step 3, you can select a minimum price. This means that your tender will not be accepted if the buyback is less than the minimum price that you have selected. And lastly, tenders must be received by the registry or processed by your broker through CHESS by no later than 5 p.m. Melbourne time on the 21st of October, 2022. So Matthew, what is the Lincoln Fund's perspective of the buyback, and will you guys be participating?
Yeah, good question, Jace. And look, absent any nasty announcements between now and the close of the offer, the Lincoln Australian Income Fund would intend to participate in such an offer, as we do try to maximise the total return for our unit holders, inclusive of franking credits. Now, the Lincoln Australian Growth Fund thinks a bit differently and measures its total returns differently. So these type of offers don't generally appeal to that unit holder base.
Right, so thank you so much for your input, Matthew. If you've enjoyed today's episode and looking for more educational tools, then consider joining our Lincoln Live sessions every Monday, where we talk about market strategies and answer your questions on stocks. Another friendly reminder that Thursday and Friday are public holidays next week, so there will be no Taking Stock episode next Friday. In summary, interest rate volatility remains front and center. It is important not to panic, as there is not much you can do regarding systematic risk. However, you can reduce stock-specific active risks by ensuring you maintain a well-diversified portfolio of at least 15 financially healthy stocks. We also recently released our Mastering Stock Exit and Re-Entry Strategies video for those keen to understand a bit more about Lincoln's strategies. This video is located in the Resource Center under Stock Doctor Educational Videos. Well, Matthew, any last words?
No last words there, Jason. Look, thanks for having me, and I echo those thoughts there. Volatility is going to remain a theme throughout this year, so stick to quality.
Thank you so much. Take care, everyone, and have a safe and healthy week.